bigger picture, I think we still feel very good as we fast forward through this period of uncertainty. We believe travel is a secular winner, and we think hotels are going to be a big beneficiary of that going forward. Again, once we kind of work through some of this policy uncertainty that's clouded the markets in the near term.
I'm here today with John Stanner, President and CEO of Summit Hotel Properties. Thanks for joining us.
Thank you.
How do you see business and leisure travel patterns shaping up for the rest of the year and into 2026?
Yeah, well, I think we're, generally in a period of a lot of uncertainty today. I would say that we were really encouraged with what we saw from a demand perspective in January and February. We were up a little over 3% in those 2 months combined. Things started to turn in March, and that was largely driven by a pullback in government spending. And I think between what we've seen with DOGE and then some of the tariff-related noise and the policy uncertainty, we have seen kind of a modest slowdown in demand. Most of that has been concentrated, as I said, in government sectors. We've actually been pretty encouraged in terms of the stability of what we've seen and negotiated. Leisure has been generally flattish. That tends to be the most durable demand segment for us in periods of economic uncertainty, and we would expect that to continue. I think we'll see a little bit less inbound international travel over the summer. I think we will offset that with better domestic kind of drive to leisure travel over the summer. Bigger picture, I think we still feel very good as we fast forward through this period of uncertainty. We believe travel is a secular winner, and we think hotels are going to be a big beneficiary of that going forward. Again, once we kind of work through some of this policy uncertainty that's clouded the markets in the near term.
And how have you positioned your balance sheet in order to be the most effective and successful in today's markets?
Yeah, well, we've done a lot of really good work on the balance sheet, and we are in great position. Just this year, we did a new delayed draw term loan. We have a large convertible debt financing that matures in February of next year. It's a 1.5% coupon, and it's an extremely attractive piece of paper. And so we put in place a new delayed draw term loan that allows us to keep the convert out through its maturity date. We've eliminated the overhang from the maturity, but again, we'll be the beneficiary of that lower coupon rate through the maturity. We also just announced a new secured financing, a $50 million secured financing to refinance our existing mortgage on our AC element in the Miami Brickell market. So the balance sheet's really in good position. We have no maturities really through 2027. We have over $300 million of liquidity. We feel really good about how we're positioned. It's given us the flexibility and capacity, frankly, to buy back some stock while we've seen some near-term dislocation in the pricing of lodging REITs.
And are you seeing any geographic shifts in demand or investment focus within your asset class? And what's driving those changes?
Yeah, look, we generally think of ourselves as being market agnostic. We believe that we're looking for, markets and opportunities where there's mispriced risk, or we believe that we have a different view and ability to add value or see a supply-demand picture differently than other people in the market. If you look at what we've bought since the pandemic, we've bought over $1 billion of assets. A lot of that was concentrated in the Sun Belt. I think immediately coming out of the pandemic, we saw better demographic patterns, corporate relocations, people migration into some of these Sun Belt markets. We've been very active in some of the mountain markets, which are really high barrier to entry markets. There's very difficult to build new supply in. But our last two acquisitions, we bought an asset outside of Boston and an asset outside of Washington, D.C. So urban markets, kind of submarkets of gateway city markets where we felt like the better growth profile in the near term has been in urban markets as BT recovers, which has lagged in the recovery, has provided us, a little bit more of a better growth profile going forward. So we try to be, again, market agnostic. We try to be opportunistic around where we see value and better upside. And I think, again, we've got a good track record of that coming out of the pandemic and allocating capital accordingly.